Yes, Japan's stock market is stronger than Singapore's, and that's the problem. Let's stop pretending this is complicated. Yes, Japan's stock market is stronger than Singapore's. Stronger EPS, lower PER, cleaner PBR, better margins, better shareholder returns. On paper, Japan looks like the most efficient equity market on earth, and that efficiency comes from one place only. The Japanese people are being squeezed dry. This is not innovation. This is not productivity. This is extraction. Japanese companies don't grow profits by inventing the future. They grow profits by not paying workers, not investing, and hoarding cash like a bunker economy preparing for collapse. Let's talk numbers, because feelings don't move stock prices. Japan's listed companies are sitting on record-high internal reserves, trillions of yen parked on balance sheets, cash not reinvested, cash not returned to employees, cash quietly recycled into buybacks and dividends. Why does EPS look so beautiful? Because wages are flat. Why does PER look so cheap? Because the denominator, human labor, has been crushed for 30 years. Why does PBR finally improve? Because assets are sweated harder, workers are pushed longer, and corporate Japan learned one trick. Don't grow the pie. Just take a bigger slice. Singapore's market is disciplined. Japan's market is ruthless. Singapore balances capital and labor. Japan sacrifices labor to worship capital. That is why Japanese stocks outperform. A Japanese worker produces global class returns while living like it's still the 1990s. No wage growth, no pricing power for households, no social upside, just immaculate balance sheets and smiling IR decks. This is why foreign investors love Japan. Not because Japan is strong, but because Japanese people cannot fight back. Lifetime employment collapsed. Unions lost teeth. Inflation arrived late, then wages never followed. Corporate Japan realized something terrifyingly simple. You don't need happy citizens to have a great stock market. And so the Nikkei climbs while living standards sink. This is not a paradox. It's the business model. Why Singapore can't beat Japan in stocks without destroying its own society. Here's the part investors hate hearing. Singapore cannot replicate Japan's stock market strength without breaking itself. Japan's market wins because it made a brutal choice decades ago, sacrifice households to protect corporations. Singapore refused to make that deal. Let's break it down cleanly. EPS, Japan, wins by starving labor. Japanese companies juice EPS by keeping wages frozen while productivity inches up. No bonuses, no real raises, no pressure from voters because voters are exhausted and aging. Singapore companies don't have that luxury. Singaporean wages rise because the state understands something Japan pretends not to. If households collapse, the city dies. That caps EPS growth. Investors hate it. Society survives anyway. Japan chose the opposite. Japan looks cheap because growth is fake. Japan's low PAR is not a bargain. It's a warning label. Low expectations. Zero faith in domestic demand. No belief that citizens will ever spend more. Singapore's PER is higher because markets expect consumption, mobility, and human capital renewal. Japan's market says, these companies will extract value forever, but don't expect joy. And investors nod. They don't need joy. They need yield. PBR. Asset sweat versus asset trust. Japan improved PBR not by innovation, but by sweating assets harder. Factories run longer. Workers cover 2 jobs. Capex delayed. Maintenance postponed. Singapore's PBR reflects trust. Japan's PBR reflects pressure. One is sustainable, one is profitable. Guess which one pumps stock prices? Cash hoarding, the silent weapon. Japanese firms sit on absurd internal reserves, not to invest, not to raise pay, but to defend margins in a dying economy. Singaporean firms circulate capital. Japan entombs it. Markets reward entombment because it reduces risk. Dead economies are predictable. That's gold to global funds. The uncomfortable truth: Singapore protects people first, capital second. Japan protects capital first, People last. That is why Japan's stock market hits harder. Not because Japan is smarter, not because Japan is stronger, but because Japan accepted social decline as collateral damage. Singapore still believes prosperity should be shared. Japan decided it was optional, and markets made their choice. Foreign investors know exactly what they're buying, and it's not Japan's future. Here's the lie everyone pretends not to see. Foreign investors are not betting on Japan's revival. They are betting on Japan's inability to resist exploitation. That's the edge. Global funds don't ask, will Japan innovate? They ask, how long can Japanese workers endure this? And the answer keeps getting revised upward. The investor logic is cold and simple: aging population, declining labor force, no immigration shock, no wage uprising, no political backlash. To an investor, that's not a crisis. That's predictability. Japan is not volatile. Japan is compliant. That's why capital flows in. Labor as a fixed cost, not a stakeholder. In Japan, labor is treated like a utility bill, something you minimize, not something you nurture. Lifetime employment is gone, but obedience remains. Non-regular workers absorb the shock. Middle-aged workers disappear quietly. Young workers lower expectations before they even start. This is a dream scenario for EPS modeling. Costs don't spike, strikes don't happen, politics doesn't interfere. Singapore cannot offer this. Its citizens push back. Its voters matter. Its social contract still exists. Japan's barely does. Governance reform didn't save workers. It saved valuations. Everyone claps for corporate governance reform. What actually changed? More buybacks, more dividends, more pressure to optimize operations. What didn't change? Wages, work-life balance, household purchasing power. Reform wasn't for society, it was for foreign capital, and it worked beautifully. Why investors? Call this stability. When foreign funds say Japan is stable, they don't mean healthy. They mean no surprises, no populism, no labor revolt, no redistribution. A country slowly shrinking, quietly suffering, and politely complying is easier to price than a young, angry, demanding one. Singapore is dynamic. That scares money. Japan is resigned. Money loves that. The brutal summary: Japan's stock market outperforms because human downside is capped. Workers won't quit en masse. Voters won't revolt. The system won't break suddenly. It will just grind. And grinding systems generate returns. This is not an accident. It's the product. This model works until it doesn't. Japan is already past the warning line. Japan's stock market model only works while there is something left to squeeze. But eventually, the base collapses. When citizens stop spending, companies stop growing. Buybacks replace innovation. Cost-cutting replaces strategy. That's not strength. That's end-stage optimization. Demographics are the kill switch. Japan is running this model on the oldest population in the developed world. You cannot squeeze a 60-year-old workforce the way you squeezed a 35-year-old one. Japan's corporate strength is a sign the system has reached maximum efficiency at minimum humanity. That's the last stage before decline. So, is Japan still a buy? Yes, right now, today. Investors are still buying Japan because it offers something more valuable than growth: control. Costs are predictable, politics are slow, workers absorb shocks quietly. But every yen returned to shareholders came from somewhere. Japanese companies didn't become efficient, they became extractive. The market is strong because the people are weak. That's the equation. If you're an investor, this is attractive. If you're a citizen, this is catastrophic. No mystery. Just numbers doing what numbers always do when humans are reduced to inputs.